You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
This is the facility that we closed on today. Okay, I want to show you. It's called Beacon Storage. So obviously it hasn't been changed yet. But it's at 201 East Main Street in Leesburg, Florida. Okay. And so look at this Google page right here. And what is missing? We've talked about this before. When you look at Google Maps and you pull up the storage facility, like what is going on here, right? So first of all, you can see Beacon Storage. The storage is not even capitalized. That's a bad grammar. Come on, you can at least get the grammar right? Beacon Storage. So that's for me is a key. Wow, this might be a hint, right? And then also on here, it does not have a website. There is no website. No website. So that's not on here. And then if I open this up, look at this. They're open 9 to 5, Monday through Friday, 10 to 2 on Saturday, and closed on Sundays. Now this facility is an indoor climate controlled facility. Indoor climate control, right? Couldn't you be open from 7 in the morning until 10 o'clock at night or something? I mean, why would you only be open 9 to 5 Monday through Friday and then 10 to 2 on Saturday, right? To me, when I see that, I'm thinking, what? That does not sound normal. Now let me show you this. So this is it here, right here. You see Beacon Storage, right? So this is what it looks like. You can see it on Google Maps. And then here is the facility. So it's just a massive building, and it's got storage, and then it's also got commercial space. Okay. So now you can see here, there's a big open space park right here. I think they're building some stuff here. I'm not 100% sure what they're doing here. But this right here is Beacon College, right? Or Beacon University. I can't remember which one it's called. But essentially this university or this college is a very famous college for disabled people. Right. So people from all over the world bring their kids to this university, and it's special for disabled people. And this is downtown Leesburg. This is Main Street. All right. This is Main Street. So Leesburg is the next street after the Villages in Florida. All right. So if you've heard of the Villages is where a lot of old people go and just retire, chill out, do their thing, whatever you do in Florida. Right. And so this is the Villages is the retirement community, and the Villages is booming. It's booming. I mean, when you drive through the Villages, let's see if I can show you this real fast. When you drive through the Villages, you just see nothing but construction everywhere. If anybody knows what I'm talking about, right? So that's this 44. Here's the Villages, right? It's right here. So when you're driving through, actually, I don't know if it's this one because I don't know the area, or no, it must be this one. It's the 441 is what it is. No, it's not. It's the 44. Anyways, I don't know, but there's a lot of construction going on. All right. And there's a lot of construction. I've driven through here several times. You guys can tell me if y'all know. Okay. I've driven through here several times. There's so much construction going on. So this area, I would honestly consider this I would say maybe secondary market, but it's going to become primary market. It's I would call it a sub-primary market is what I would call it. Okay. Sub-primary market, which is just north of Orlando. So you see, here's Orlando right here. And everybody knows Orlando is just booming right now. I mean, it's just growing. And it's just it's growing everywhere, but it is growing up in this area. So it takes about, with traffic, it takes from Orlando to Leesburg about 45 minutes, right? So without traffic, it's probably around 30 minutes. Okay, something like this. There's always a lot of traffic because it's just like crazy. It's just like crazy up there, right? So this is where we're at. This is where we're at. Okay, so now, and then I was going to zoom in and show you, yeah, the satellite imagery. All right, so you could see this, and you can see, yeah, here's the yeah. So this is the main street, and actually we always drive. Yeah, so when we come in, we drive on the main street. That's how we get here. And then we kind of go through and then we go over to the 75. Because I live in Tallahassee is where I live. So it's about maybe a 3.5-hour drive from Tallahassee. And so they're really building out this this Main Street area. It's a very, very cute street, actually. It's very walkable. This whole area right here, this is where the university is and everything. This is like super walkable. And they're making this Main Street kind of one of those, like, you know, it's like a whole bunch of shops and restaurants and like bars and stuff like that. So it's a really cute area. And we just happened to buy this. We just happened to you know, find this facility and, you know, and started looking at it. This can be a very, very good buy and hold. All right, very good buy and hold. Okay, so now am I going to buy and hold it? No, maybe not, probably not. But like, I'll tell you guys kind of my thought process on this. So the property here, it goes to, it's like right here. I'm not sure if I can draw on this. Yeah. It's kind of like this is what it is. Okay. It's like, actually it comes out to right here, but there's this like half of it. And then there's another half owned by the Ross family. And so this area right here, like this whole area is also it could be considered parking. Now they're not doing anything to this. They're not doing anything at all to this. It's just like empty. Well, actually, so this part of the building, probably to about right here, this is commercial space. And then right here, there's like an office and there's like a guy that does Penske truck rentals. So when people come into the storage, he offers them, you know, to rent a truck to move and stuff like this. And he's been there for like years. And so, you know, he has a couple of Penske trucks, like maybe 3 trucks that he like take up a little bit of space. But there's some parking here. There's a little bit of parking here. And then there's like a little kind of storage area here. All the rest is open parking. So we're going to try to figure out what we're going to do with that. That was not included into our numbers. Like we did not put this area right here into our numbers at all. We really only looked at the commercial space and the storage is what we did. Okay, that's kind of how we did it. And then this will be a bonus. And what's really good is you can see here, this space right here, this has been converted to boat storage. So somebody bought that piece of property and they have stored boats, like they store boats there. This is like huge boating community, this area. And then also right here, this is also boat storage. So somebody bought this piece of property and then what they do is they do boat storage, but they stack the boats up. And, you know, when they're not being used, they kind of stack them up. So that's what they're doing. So, I mean, obviously boat storage is going to be something that we're going to consider and look at, but we're going to try to figure out something in that area. But for the numbers I'm going to show you today, that was not included. That's going to be an added bonus, whatever we figure out we're going to do. Okay. And so yeah, and so you can see there's like that's like Pauling's outdoor storage lot is basically what it is. So there is parking going on there. So we could do more parking if we wanted. This is what the building looks like. And so then I wanted to show you guys pictures of this too. So let me see here. All right, now we're talking. What I did is I went to Crexi. All right, so Crexi, if you don't know Crexi is like the online portal where realtors list properties for sale. Okay. But another thing about Crexi is that Crexi holds all of the, like any commercial property that's ever been sold since the 1960s. Since the 1960s, it will give you that information. So any commercial property. So although this property, it was, you know, came from a realtor, you can find any property that you want in Crexi. All you have to do is just type in the address. Okay. So this property was, this property was sold in December 27th, 2021. Okay, for $625,000. This is what it looks like still looks like this. So the owners, like they did nothing. This is actually considered a severely mismanaged property. So they bought it. Now the thing is the owner that bought this, the person that bought this, they live in New York. So they bought it with the intention of buying it, of like fixing it up, fixing up a mismanaged property. But in the end, they didn't do anything. They didn't do anything to this property. I'll tell you the story, okay? But I just wanted to show you kind of what it looks like. And then on Crexy, you can find like all the information out about any property that you want. You just click on the property and just click on the address and it gives you this type of information. So you can see the number of units, 179. Right. And then it has 12,213 square feet. It was built in 1952. Right. You know, so you can kind of look at it and see what it has. The asking price is $2.6 million. And let's see what else reduced to, you know, the selling price, $625,000. All right. So this is kind of where they're at. Okay. So you can kind of see where it's at here. Okay. All right. So that's that. So I at least wanted to show you a picture of it. This is what we bought. Okay. So now let me go to the deal analyzer. So actually, oh no, I wanted to show you pictures of the inside. This is the pictures of the inside. Okay, so let me go back to Zoom and let me do new share and let's do picture. Okay, so I just need to go to window, maybe is what I need to do. So these are the pictures of the inside of this. They're actually not very good pictures because I am horrible at taking pictures because I'm always just like, you know, looking and talking to everybody and stuff. But just to give you an idea, this is kind of what it looks like on the inside. So it's actually very nice storage facility. Like inside, you can see how it's all built out brand new. Right? They built this out. They put the storage units in there. Okay, so you can see it looks new, and you can see on top there's like some boxes and stuff. But this is how, like, essentially, this is inside. It's got 2 levels of units. There's 2 levels, and then there's an elevator that you can get in. I don't know if there's any pictures on that. Oh yeah, see, here's the elevator. I didn't really take good pictures of it, but here's the little freight elevator. And let's see, here's like the AC units. Everything's basically inside is brand new. Brand new. Okay, so it is a very, very nice facility, all climate control. The issue is that they could not get it filled up. Like they hired a manager to manage it, and he was not good. Okay, not good. Like he just was not getting people in. He just wasn't good at managing it. Another thing, that's number 1. Number 2, right? No website. They ended up finally getting a website, but it was kind of late in the game. Number 3, their hours of operation. The hours of operation were when that manager could be there to open the door and then lock the door. All right. And really, if you have a climate controlled building like this, like you need to have, you need to have 24/7 access. If you don't want to do 24/7, at least, 6 in the morning until 10 o'clock at night or something like this. Right. And you could always monitor to see when people come in, because you should have cameras and you should have a keypad and you should have a system for letting people in if they have their code and stuff like this. I mean, that's how you should do it. Right. But they never set any of this up. So there's no cameras. There's no keypads. The owner did not want to spend any money on this at all, right? Outside of just these units here. Okay. So I wanted to show you all that. This is on the inside of it. Okay. So now you kind of have an idea of what it looks like. I want to go over the numbers with you. Okay. What are your thoughts? What are your thoughts on numbers and would you buy something for a bit like this? I would love to hear what you're thinking on this here. Let me see if I can figure out, where did I put the deal analyzer at? There it goes. So this is the numbers. This is my deal analyzer. This is what I told you that we can, you can go to the website if you want. If you need a way to run numbers, I'm telling you, this deal analyzer is awesome. Okay. So because the reason why is because it allows for creative deal structures. There's no deal analyzer out there that really kind of helps you with coming up with good creative deal structures. And I really like to do owner financing offers. On every deal, I always offer owner financing. Okay. So this page right here, this is the info tab. We call it the info tab, but this is really kind of your inputs. All right. So the question is, when you talk to owners, what's the information that you need in order to get, to run numbers? And I talked about this a couple of weeks ago when I did one of my Monday nights, is you have to remember the difference between going on to, talking to a realtor and getting the information from a realtor, or going to an owner and getting the information from an owner, right? A lot of times the owners do not have all of their, all their data and stuff. They don't have P&Ls and balance sheets and stuff like that, ready. They can get those ready. It takes a couple of weeks to get those ready, but you really just need to have numbers in order to run a quick deal analysis. So when I talk to the owners, really anything in yellow you see here is what you're going to be asking the owner, right? So you're going to be asking the owner for their annual income, and right, so annual income is right here, and then their number of units and the total square footage, and then their vacancy, right? Their economic vacancy versus their physical, this is really kind of physical occupancy is what this is, right? And then, so you don't really have to ask, but you can ask for, let's see, property taxes, you can find yourself, utilities and insurance. On my deal analyzer, these formulas right here, those are like just populated formulas. Okay, because you can figure it out. You don't really have to ask the owners for this. You can figure out what the property taxes are. You can figure out what the insurance is. Essentially, you see, yeah, the insurance for us, our formula is the max times 1,200 and then 12 times C13. Right. So that's kind of how we run our numbers, is we just kind of have an idea. We put the formula right in here. We put the formula for the property taxes right in there as well, too. So we kind of just look at like, what's the average millage rate for like property taxes, so we can run that formula. All right. And then utilities as well is a formula. Okay. So, and then these right here, these are our expenses. Okay. So we don't ask the owner for their expenses. All right, because their expenses are not going to be our expenses, right? A lot of times owners are managing everything themselves. They're as lean as they possibly can so they can save every penny and everything like this, which is what you're supposed to do. But we don't go to our facilities and manage our facilities. We have people that do that for us. We have boots on the ground and things like that. So that is where the property maintenance, the staffing, the software, the merchant fees, and the marketing all come into play. Now you can ask them what their expenses are and look at what their expenses are, right? But like, you need to know kind of what your expenses are going to be. Now, our deal analyzer, these expenses are a formula as well too, right? Because we know what our expenses are. So we just use a formula for that. And you can always come in and override all this if you want to, but we just kind of keep this. And I tell all my students, just kind of keep this, because this is kind of sort of where it's going to be. It might be a little bit less, it's going to be there. Now, okay, and then you can see the mortgage payment is automatically populated, okay? Now, this is your inputs tab. Now, when we look at our deals, we look at 3 ways of analyzing the deal. We look at the current, the potential, and the after updates, which is really as is right now. What is the value of the facility? What is it doing right now? Right, that's current. And then potential is like, is it a mismanaged facility or not? Right? Mismanaged. If it's mismanaged, potential means, can you get it from 50% full to 8% full, right? That's what we call potential. Is there potential in the deal? Can we get it from not full to full, right? And then on the third way we look at the deal is what we call after updates, which is really opportunity. What is the opportunity in the deal? What can we do? Can we increase the units and the square footage? That's number 1. Number 2, can we increase the price per square foot? That's number 2. Okay. So the question is, what can we take this number to? What can we take the number to? Okay. That's kind of how we that's how we evaluate our 3 deals. So you can see here that once you put the inputs in, it already shows you what the valuation of the property is. Now, this facility was making when we bought it, it was making $108,000. It's making around $9,000 a month is what it's making. All right. So we put in $108,000, and then the number of units, after we started really looking at the number of units, we figured out that there's really 143 doors, and there's a little bit over 10,000 square feet. Now, there's some areas where you can add more units, kind of a big open area, but we did not do that. We did not add that in. We just looked at, this is what it's offering right now. And then also we looked at that it's 50% full. Okay. Now, when you're running numbers, you do not want to add the commercial office space into this. You don't want to put the total amount of the building is 25,000 square feet. You're not going to put 25,000 square feet plus the square footage plus, of the storage plus the office space. Because what that does is really skews the numbers, right? It will skew your price per square foot. So we separate out all incomes. So commercial space so office space is looked at differently because the price per square for office space is different than the price per square foot for the storage. Okay. if that makes sense. And what we do is we have current, potential, and after updates. We have 3 tabs. We have the current, and then we have the potential, and we have after updates. And that is where we're analyzing all the separate types of incomes. All right. So let me see, we can undo this. And then I could say current. Yeah, current is here. When you look at the deal, the current numbers for the deal, you'll see that, the price per, it's 143 units. The price per unit is about $125. It's 50% vacant. There's no management fee. And then also the purchase price is $2.5 million. The valuation comes out to $282,000, just the way that it is right now, without any other incomes or anything like that, because it's only making $108,000, right? And then the equity, so we're negative $2.2 million in equity. The NOI comes out to 19. So as is right now, this is what the numbers look like, right? This is what the numbers look like. The gross potential rents for the storage are $216,000. Right? This does not include any other income. This does not include any commercial space. This does not include the parking space outside or anything like that. It's just like as is, like if we filled that storage facility up, we should be making around $216,000. Remember, it's making $108,000 and it's 50% full. Okay, so that's the income. The effective gross income is $108,000 because of the vacancy. And then you can see all of our expenses are here: insurance, the property taxes, the maintenance, the utilities, the staffing, any management fees, software, marketing, and the mortgage payment. Okay, is all right here. Okay, now another thing I didn't point out on this deal analyzer is that you can toggle between 4 different deals. All right, so I could click on this one here and I could toggle into, it's not doing it, but I could toggle into a cash offer and then 3 creative deal structures, right? And so I can you can check if I was running the numbers for a cash offer, I could look at the numbers and see what that is. If what's your cash on cash return? What's all the numbers for that? If I was doing, the 3 different, I could show you that here, but so you can see there's 5 different ways to run numbers on the deal analyzer, and you can toggle between each one of these on the deal analyzer. Right. So you can see the cash offer was 2.4 and the owner financing offers were also at 2.4. And then we offered 3 owner financing, and then we ran the numbers at like bank financing. If we were going to go to a bank, what would the numbers look like? Okay. So that's kind of how this looks here. Let me see if I can I go up? Yeah. Okay. So what happened is we ran the numbers on 5 different ways. We presented the offer. The offer letter, right, was presented in 4 different offers. This is what we call the magic letter. It was presented in these 4 offers, and when we talked to the realtor, this is what we went through. It's look, we're going to have to owner finance this thing, right? Obviously no bank is going to finance it because it's not worth what they're asking, right? It's really not worth what they're asking. So when you're seeing something that's not worth what they're asking, then your mind should be okay, we can still get this deal done, but how can we get it done? And that's where creative deal structuring comes in, right? Coming up with a whole bunch of different scenarios to get the deal to work. And so the scenario that we came up with and what the owners ended up accepting was a $2.4 million asking price with 30% down, 5% interest, an interest-only loan for 2 years, right? So a 2-year interest-only loan. So you can see the numbers here. So the loan amount actually comes out to $1.68 million. So we're borrowing $1.68 million from the owners. They're going to be they're going to put the lien on the property and they're lending us that money. And then we're going to pay the 5% interest on that money, right? And then we have to put $720,000 down, right? We put $720,000 down and the monthly payment is $7,000 a month. So we are doing interest only payments for 2 years at $7,000 a month. Okay. That's what we're doing. So that you can see here that the targeted cash on cash return is 10%. 10% is a great number. for cash on cash. If anybody agrees with me, put yes. I love 10%. 10%, I would do 10%. If you say no, 10% sucks, I would never do it. Put it in. I want to know, what do you think about 10%? So our goal is to get 10% cash on cash return or more, right? This deal ends up being 35% cash on cash return. All right. Now, remember, we have 2 years to stabilize this property. 2 years. All right. And then in 2 years, what could we do? Right. 2 years, we can refi out, right? We could definitely refi out in 2 years, or we can sell the property in 2 years. And honestly, running the numbers at selling the property in 2 years gets you a ridiculous IRR. It gets you like 100% IRR. I'm going to shoot for trying to stabilize this property in 2 years and selling it in 2 years. But if I can't stabilize it and get it to the returns that I want. So you can see here, the return that I want is $5.4 million, $5.5 million. That is where my goal is, right? So I'm taking it from, 50% full, filling it up, and then also getting the commercial real estate filled in, getting the money, and then we could refi it. We could either refi it out in 2 years, or we could sell it in 2 years. Okay. Now, remember, I put this facility into my fund. This is in the Self-Storage Fund of America. All right. So what is the goal of an investor that puts money into their fund? What's the goal for that investor? To get their money back as fast as possible, right? So that is what I'm thinking about, is how can I get the money back as fast, at least the money that they put in, back as fast as possible. Okay. So that's why I'm thinking, if I can stabilize this thing in 2 years, why not just sell this one and just give them their money back. Okay. All right. Because I saw Mark, I saw you were asking that. That's why I said, what if I get pregnant again? No, I'm not going to get pregnant again. It's impossible. Sorry. Yeah. I'm too old. I'm 46 years old. I can't get pregnant again. I can't go through that. No. Okay. So, all right. Okay, so $5.4 million is our goal. Now, just taking it from 50% full to 92% full, I take the value of this property to $3.3 million, right? So just by filling up the storage, I'm taking it to $3.3 million, right? Because you can check on the current, and then you can also go to the valuation potential, right? You can see the potential for this, right? So now also what you can see other income is $126,000. So the commercial property is already making $126,000 as of April 1st. So they had the office got rented out, and the office is paying $9,000 a month. $9,000 a month for the front space. Remember that? You remember where the window was, like the ugly windows? So that is a whole office space, and they rented that out for $9,000 a month. And then on top of that, there's 3 other spaces. There's 3, maybe 4 spaces that you can rent out. One of them is being rented out for $700. This little tiny office is rented out for $700 a month. And there's 3 other potential spaces that could be rented out. But really the main thing is the office space is $9,000 a month. So that's what we calculated, which the tenant moved in as of April 1st, which is good. That was one of my stipulations, is that the tenant needed to be moved in. Because when we started talking to them, we started talking to these people in November. They had just gotten a tenant to sign the lease. And I was like, okay. And they were doing some renovations and stuff like this. I said, okay, we'll close on the property once the renovations are done and the tenant has moved in, which happened on April 1st. So they're making so it's $9,000, so that's another $108,000. And then there's a $700 a month one that we calculated and added into as well too, something like that. So that's kind of where we came up with $125,000. So already, as of right now, it's making the $108,000 for the storage plus $126,000 for the commercial space. All right, so we should be at $342,000. So we should be making $342,000. That is not including the outside space. We did not include that into the numbers at all because we're not 100% sure what we're going to do with that. We're going to figure it out. We're going to maybe look around, see what the best thing is to do with that outdoor space. But as of right now, we are on the path to make, I guess, 126 plus 108 is where we're at, right? And then you have to minus the vacancy, right? And then you could see here that the, and oh, sorry, this is when we get it full as well too. Sorry, my bad. This is where you're getting it full as well too, right? So you're taking it from potential to full. So now you can see the vacancy is deducted by $17,000, right? So that's it. Like 8% vacancy equates to $17,000. So that's deducted. So you can see 342 minus the 324. So our NOI after our expenses, right, is 236,000. Notice our expenses include the $88,000. I'm sorry, for the mortgage. Okay, so that's how you get to $236,000. And okay, so that's the potential, which means we added the commercial space and we added the taking it from 50% full to 100% full. All right, so you see how I'm kind of breaking down the scenarios, and we do that in the deal analyzer. So you can really look at several different types of scenarios. And then on top of that, so these three tabs, the valuation, current, potential, and after updates, is really three different types of scenarios. And then the financing inputs is like the four different types of offers, the four different ways that you can make offers and run your numbers and do things. Okay, that's kind of how it's broken up. So then on top of that, let's go back to the info page, and I'm going to show you. So we came up with $3 a square foot. So in Leesburg, right? So in Leesburg, there is only 4 other storage facilities that do climate control. That's it. And then within I think we did like a 2 or 3 mile radius. So we didn't go too far out, but we did go out because actually there's no competition within like a mile radius. So all of our competition is like past a mile up to like 3 miles. So we're really like very centrally located. And actually a lot of the tenants are students. And it's funny, it's very interesting because of these tenants, guess what? If you're a student, you don't want like a huge 10 by 20 unit because you can't afford that, right? You want like a 5 by 5 or a 5 by 10 unit, right? So a lot of our units, think about that. A lot of our units are the smaller units. And you have to remember that smaller units have a better price per square foot than a bigger unit. Right? So you have to think about that too when you run your numbers, because Pete said, as soon as we buy this thing, we are making more 5 by 5 and 5 by 10 units, because when we were talking to the manager, he was saying that they don't have enough 5 by 5 and 5 by 10 units for all of the students. And so a lot of those units that are not being rented are, 10 by 10s and 10 by 20s, because the market just doesn't call for bigger units. So when the market doesn't call for bigger units, I mean, you as the owner, you have to put that into perspective and see what you can do to fit what the market needs are. Because a lot of those units from the college, the Beacon College, they come over and they get all their whatever can't fit into their little tiny dorm room is going into this little storage area. So we need to be thinking about that, right? So Pete's like, I'm going to just get in there and switch around units and stuff like that. He's like, I'll just bring some people in and we'll figure this out. Is what he'll do. Okay. And because Pete is one of those types of people, my husband was, but he'll just get in there and just fix stuff, he'll get in there and just take it apart and redo it and try to figure it all out. Okay. Anyway, so now you can see here this $3. So we're not adding any units. It's 143 units. It's 10,200. And the thing is you saw on the listing, he said 179 doors. There's not 179 doors there. There's 143 doors. So obviously he got that information from the owner and the manager. So the owner and the manager literally have no idea what the heck they're doing. All right. So we had to get in there. It took forever for us. Pete had to go down there and really measure everything out, get all the doors, get the square footage, and figure everything out. And that's when we came up with the 143 and the 10,234. Okay. And even when we got all the data from the owners, because they ended up using in the last 6 months, they started using U-Haul, which is one of the platforms that you can use for storage. They have a storage platform that you could use. And they gave us the rent roll, and it was just totally screwed up. So they had to work through all this stuff. And when you buy a mismanaged facility, that's kind of what you have to work through. So in the end, we ended up doing what we call the competitive analysis. And the competitive analysis is where you could see the 4 storage facilities within, actually, you could see one's 0.7 miles away, one's 1.2, 2.5, and 4.8. So there's not a lot of climate control within a 5 mile radius. 4 facilities, well, 5 facilities within a 5-mile radius for climate control, which is very good, right? Which is very, very good for us. So that means that we have a advantage, a little bit of an advantage on that. And let me see here. So, and then we go through, and what we do is we call all the facilities, right? And then we just, try to figure out what we're charging versus like what everybody else is charging. You can see all the prices here, okay? And then we just compare them apples to apples, and then we do the price per unit and the price per square foot. That is where we come up with the info tab. Actually, we put all of there's a unit mix tab. Look at how many units and how many sizes they have. They have a lot of different sizes. This is a lot of sizes. You go in, you look at every single size, you put it down, and you figure out what's the total square footage, and then what their prices are, and then you kind of look through and see like what the market rate is and this kind of stuff. Okay, so that's kind of how we came up with this number here. Okay, that's how we came up with this number. And so that's kind of how we came up with the $5.4 million, is based on what the competition is charging and, what we can charge, really, is what it is. So that's kind of where we're at. All right, so that's the deal analysis. All right, that's the deal analysis. And so this sheet here is available online if you want to purchase it. What I wanted to do real fast is just kind of go through. So this is the valuation page, and I'll just show you this is the terms that we got. All right. So as you can see, as is, we're on owner financing 1, right? So you can see current, the cash on cash return is negative, right? Obviously we're negative, right? But then once we get it to the potential, and once we get it to the opportunity, you'll have around $40,000 of income. We already have we already have $20,000 in income. I mean, essentially, as of right now, there's $20,000 of income. We're going to double the income by increasing the rates, getting it filled up, and then increasing the rates. So we calculate $40,000 in income. Operating expenses are only going to cost us about so much minus the mortgage, right? Which makes it a 35% cash on cash return. All right. So that's the deal analysis. That is the deal that we got. Again, we got an owner financed. It's $7,000 a month for 2 years is what we got. And actually what happened too was, it's very interesting because the owners, the people that owned this, the ones that bought it, they were also getting the deal owner financed. They were also getting the deal owner financed. In their mind, they were like, okay, we've got to pay off the loan that we have. So because of that, we need to have like X amount of cash and stuff. In the end, basically what we convinced them to do is we convinced them to, and the thing is they owed like $700,000. They're like 600 and something grand, is because they paid cash and they hadn't really paid anything down or anything. So they owed $600,000. And so in the end, we told them that we would give them $700,000 down, but what we would do is we would assume the first mortgage's loan. We would assume the first mortgage's loan. So that's really what happened. We convinced the owners to do an assumption on the first loan, and the second loan we just took out so basically it was like $550,000 assumption. And then it's also a $1.2 million $1 million loan from the owners, something like that. $1.2 million. So we actually have 2 mortgages on this property. We have one, which is the assumption, which the owners allowed us to just assume that loan. And the second one is like the lien, is like the main one with the $1.2 million from the second owner. It's like super creative. And so the good thing now is that we only have to come up with $7,000 over the course of the next couple of years, every month to pay them. And we're going to do 2 separate loans. Essentially, it's 2 separate mortgages. It's like, a couple $1,000s for the one, and then, the rest goes to the other. And let's see, and what else? Yeah, and I think that's really it. It's 2 different loans on the property, plus $700,000 down is what it was. And I have 2 years to stabilize this property. And hopefully I can sell it in 2 years and then just give all my investors the money back. But if not, then I could always just take out a loan, and then I could just refi it out, and we could just hold on to the property if I need another year or something like that. So we'll see what it is. And that's really, so that's yes, exactly. That is a wrap. We did like a wraparound mortgage is what we did. Something like that. It's not really a wraparound mortgage because we assumed the loan, but think about it in terms of that, is that you can do wraparound mortgages. You can assume loans if the owner will allow you to assume the loan. the owner could do a second on the back end if they want. There's just all kinds of creative deals. Okay, so that is what this deal analyzer is for, to help you run numbers and to come up with a lot of different types of offers that you can offer. Now, and then if you decide to get the deal analyzer, there's a whole bunch of videos that go along with it. And then also, if you really are interested in learning how to do structures like this, which I highly recommend because it is very, very difficult to buy property right now. Not impossible, but very difficult to buy property with bank loans, then you should really consider, joining Storage Nerds and coming to the boot camp, which is coming up in the next month. And I will spend 2 full days talking about assumptions, wraps, owner financing, taking a second, raising capital. It's, raising capital for deals. Because actually I raised the $700,000 to put down. I raised that money. I just raised it. And so I will talk about that as well too. How am I raising the money? Because I don't put any money into any of my deals, hardly ever. I don't put any money. I just use everybody else's money. It's online. Yeah, everything I do is online, Nick. So it's everything, all Storage Nerds, the coaching program is all online. And so I will hold your hand and walk you through all that as well too. But you go to storagenerds.com for that and check it out. And let's see what else. And then if you want my course, go to stacyrossetti.com. You can go to storagenerds.com. The deal analyzers at storagenerds.com. Everything is right there. Okay. All right. So now I'm going to hop off really fast. I'm going to go to my pitch. It's stacyrossetti.com/fund, FUND. If you're interested in putting money into my fund, you could be part of deals like this, and you could just learn, see how I'm doing everything passively, okay, as well too. All right, take care, and I will see you guys at the next Monday. Take care.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.